If you're buying a home in the DC area, the DMV, Montgomery County, Northern Virginia, there's one thing that causes more confusion, more frustration, and more last minute stress than just about anything else in the process of buying a home. It's not the inspection, it's not the appraisal, it's not even the paperwork. It's insurance. Insurance is supposed to protect you. It is the one thing that causes most people to go into a little bit of a frenzy trying to understand it. And the problem with it is that most of it doesn't even protect you. Some of the insurance you're going to buy when you buy a house doesn't even protect you. Most buyers think it's just a thing to get or a box to check on the lender's application. The fact is, there are several types of insurance that are going to be involved, and you want to pay attention to each one of them because they each do something different. You're going to spend several $1,000s or more in the process of the transaction to purchase insurance. And like I said before, some of it is there to protect the lender and doesn't even protect you, yet you have to pay for it. So you want to know what you're buying. You want to know why you're buying it. You want to know that you're buying it in the right quantity for what you need and not just so someone else can get a bigger commission off your purchase. And that's what we're going to talk about. Now, why is there so much confusion in the area of insurance? Well, frankly, I think it's designed that way. Insurance is designed to spread the risk across more people than just one. And in that process, it becomes a very confusing, very complicated system. And if it weren't that way, it'd be great. But it is, and partially designed that way so that it is hard to see through. Some of the insurances you're going to buy are going to protect you. Some of the insurances you're going to buy are going to protect the lender. And some of it, if you're buying a condo or an HOA, is designed to protect the condo association or the homeowner association. So while you have to buy it, it may not even protect you. Part of the problem too is that often the costs that you're going to incur show up later in the transaction than earlier. So while you're doing all your planning, you're working out your budget, some of these things you don't find out about till later in the process. And we'll talk about that as well. So if you're feeling a little overwhelmed, it's not you, it's the system, it's the products. And we're going to break them down here. We'll start with the biggest one, and that's homeowner insurance, also known as hazard insurance. This protects you from things that could happen to the house or from liability incidents of someone else's negligence or something that happened that affected someone else. It's going to be required by every lender if you get a mortgage. So if you're buying a home, a condo, a townhouse, and you're borrowing money to do that, there is going to be a requirement that you have hazard insurance, homeowners insurance on the property to protect you, the lender, and anyone that's in the house. Hazard insurance covers things like fire, wind damage, storms, and it also covers liability if something happens to someone while they're on your property. What it does not cover is flood, doesn't cover earth movement, even deferred maintenance. So anything that happens to your house because you didn't fix it, that's not covered by homeowners insurance either. And flood insurance is a whole nother kettle of fish that we can talk about. And it's a whole different product. And fortunately, most people around here aren't going to need that. But if it is, if you are going to need it, the lender will let you know. It'll be very costly. And there's a lot to know about that product as well. Now, one of the things that catches local buyers off guard is that we have older homes. We have older homes that have older systems, older roofs, older structures. Now, older homes aren't necessarily a bad thing, and often they can be found to be structurally stronger than their earlier counterparts. However, that they are older means there's a possibility for damage that's not seen easily. The structures were built differently, so they come under different layouts and plans and engineering models and that sort of thing. So we have older products that we're buying. We have older roofs, we have older systems. The electrical systems that they install today are not like they were 50, 75 years ago, same as the plumbing. So those factor in, and failure on any of those could lead to damage to the house. And that's why the insurance companies will look at that. Many carriers are now sending out inspectors to actually check out the property. They'll look at the roof because that's a major expense if that fails. They'll look at the foundation and various other aspects of the house. So they often do actually send someone out or require a copy of your inspection report if you had one to know what is going on with that house and what's the condition of it. So that can affect your premium in a big way. The big thing that most people don't know when they're shopping for insurance is that you're not covering the property for the cost of the purchase. Now, this is really important. If you spend $500,000 on a house, you're not going to buy insurance to cover $500,000. One thing to factor in is that the land, the dirt, the ground that it's built on is generally not destructible. So you're not covering the cost of that. And there is a value in the dirt, but you are going to set your coverage up so you are covered for replacement costs. And it will cost a lot more to build that house now than it might have 50 years ago. So that's the big thing to factor in, is the cost to build the house, not the cost of the purchase. And so the cost to rebuild it could in fact be more than what you paid for it. It just depends on the house, the style, the structure, where it is, and all of that. So be very aware of the fact that you need to have replacement cost. And also your premiums are affected by whether or not you have built-in means by which that replacement cost escalates over time so that you're covered, so that you have the same coverage 5 years from now, that you're still covered and taken care of in case the house was totally destroyed and had to be rebuilt from the ground up. Now, the problem here is that often the insurer will not fully give you a quote on insurance and what it's going to cost to insure your property, or even accept you for insurance until sometime after perhaps the appraisal's done, after perhaps the underwriting's done. So while you might start the process early and get a preliminary quote, they may not give you a full quote or even accept you till later in the process. And if it happens near the end of the transaction, you could be in some trouble, because if you can't get insurance for some reason, you can't get a mortgage. If you can't get a mortgage, you're not buying that house, and that's going to be a big problem all the way around. So that's hazard insurance that protects the house from damage. It protects you from liability issues and that sort of thing. And that's the biggest part of the insurance equation that you're going to deal with when you're buying a house. The next one is title insurance. Now, you'll hear people tell you that it's a waste of money, don't buy it. Title insurance is a complete waste of money. I would think very carefully about that. There are going to be two forms of title insurance when you purchase the house. You're going to have the owner's coverage, and if you have a lender involved, there's going to be two forms of coverage for the title insurance. One is for you, the owner of the property, and the other covers the lender. If you're borrowing money and having a mortgage to buy the house, the lender is going to require lender coverage on the title insurance. If you're covering yourself or not covering, that is totally optional. The owner's policy for title insurance is optional. Now, what does it cover? It covers ownership issues. Let's say you bought this house, and when you go to sell it 10, 12, 15 years down the road, for whatever reason, an old loan from a previous owner was not paid off or not documented as paid off, and they can't find the documentation for it. Title insurance can help cover that. If not, you could be on the hook for that loan that may still be on the books. I had this happen once. Fortunately, we got it resolved, but it held up settlement for a week or two while they did get it resolved. This was an old loan from about 20 years earlier that had never been taken off the books, never got seen in a title search for some reason, and was hanging there for a little while. We finally did get documentation, but without title insurance and without finding documentation, if you own the house and there's an old loan, you could be stuck with it. Title insurance protects against unknown liens. It covers you against boundary issues, errors in the public records, which is not uncommon. It also could protect you against if someone is suing for ownership of that property. Had that happen once, where we were trying to sell a property, and unbeknownst to anyone, a family member of the seller was suing because of some problem in the family, was suing for ownership rights to that property, and completely shut down the transaction. If there are liens, if there are legal actions, judgments against property, title insurance can help with that. And in this area, because there are older homes, the chain of title can be quite lengthy and can be a bit complicated. A lot of these records way back when were done in handwritten form. And so if the papers got lost or misplaced and found later, it's not completely out of the question that something could pop up that you become responsible for because it wasn't documented in the ways that they are now. Now, the good thing about title insurance is it's a one-time purchase. You buy it at settlement. It's good for as long as you own the house and even beyond that. So it's not like you have to take care of paying this on a monthly or annual basis. It's something you get once, you have it, you keep the policy. And as long as you are part of that title chain, it could protect you against things that might come up. So that's the good news. So title insurance, two forms, Lenders is mandatory, owners is optional, but highly recommended. And in the 20 years I've been doing this, probably only a couple of people have opted not to purchase it. And I would always urge people to get it because I think despite the cost, if you don't have it and an issue comes up that costs you tens of thousands of dollars, you'd be glad you paid the few grand that it was at settlement. Now, similar to homeowners or hazard insurance is condo insurance. This used to be very much like renters policies, although over time they've evolved into more different products than they were back then. Condo insurance protects your personal possessions and it covers you for liability. It does not cover the structure of the building, but it will include, generally speaking, the walls in, the cabinets, the appliances, those sorts of things. The condo association does not cover that for you. It does not insure your loss personally of the condo. So in the event the condo were destroyed, the condo policy would be where you'd go to see if you had coverage to protect you against any loss of the unit itself, any of your personal belongings, and any liability issues, because the condo itself does not cover that sort of thing. In the past, it wasn't always required by the lender. In most cases now, they are going to require you to have a condo insurance policy on the purchase. Now, you want to shop and ask a lot of questions when you're getting a condo policy to make sure they're covering things that you need, and also to make sure it dovetails with the association's policy. You don't want any gaps. The association's policy is going to cover the building itself. They're going to have certain liability coverages and all of that, but you want to make sure there's no gaps so that where their coverage ends, yours picks up and you're not stuck in the middle. You also want to find out what the deductible is for the association, because in the event that you have, let's say, a plumbing leak or something like that that occurs and causes damage to your unit and possibly another, you want to see what the deductible is like, because you could be out a good bit of pocket change in the event something major like that happened and your insurance didn't cover it all. So make sure you're checking and asking lots of questions when you're getting that policy created. Now, if you haven't had enough coming at you about insurance, here's another one. And this is mortgage insurance. Now, mortgage insurance is one of those insurances that does not protect you, it protects the lender. If you're coming to the table and making a purchase and you have less than 20% as a down payment, you're likely going to have mortgage insurance as part of your costs, whether it's built into the rate itself or it's a separate payment you make monthly. There is, generally speaking, going to be some sort of private mortgage insurance aspect built into your loan. And again, this does not protect you, this protects the lender. It protects the lender in the event that you default on your property so that they can make up the difference between what they're out, what they can sell it for, and come out as close to whole as possible. But again, it does nothing to protect you, but you have to pay for it. The only real way to avoid having to pay private mortgage insurance is by having 20% of a down payment. Now, exception to this is FHA mortgages. Any FHA mortgage, generally speaking, requires having mortgage insurance as part of the transaction, and there will be a monthly fee for that. But if you're working with conventional products, anything less than 20%, you're going to have it. If you have more than 20% down, you're generally not going to need to have mortgage insurance as part of it. The good thing about mortgage insurance on a conventional loan, though, is once you've reached the point of 20% equity or a little bit more than that, then you will have the right to have it removed as long as you can document that. So it can go away. It will go away if you keep your payments, keep the property long enough, so that if you didn't have 20% down, once you reach that point of having around 20% equity, then you can have that mortgage insurance premium or cost go away. Now, that's not true if it was built into your rate, but if it's a separate payment, then you can work out with the lender to get it taken off. And then I mentioned briefly, and we'll mention again here, flood insurance. Now, flood insurance is a whole different scenario than any of the other insurances we've talked about. Flood insurance is regulated and dictated and set up through the federal government, and you can find it online. You can find a whole lot of information online. Flood insurance is not something, generally speaking, is required in this particular area. If you're close to a waterway like the Potomac, Rock Creek, the Anacostia, you might have to deal with it and have it be part of your monthly costs in your transaction. The flood maps that dictate where flood insurance is required do change, and the risk models are changing as well over the past few years. So if you didn't need flood insurance at some point in the past, it is possible you might need it now. And if you needed it before, maybe you don't now. So those things are changing. It's not quite as clear cut as it used to be. Big thing with flood insurance is that it is, if you're in a floodplain, it is required. It's not inexpensive, it's rather costly. And unfortunately, in the event you try to sell the property, it could become an issue in trying to sell the property, primarily due to that added risk and added cost. Even if you don't need it now, it's good to understand how flood insurance works, where it's required, and look at the maps in terms of where you are in proximity to the flood maps or the floodplains, because those floodplains do change over time. And if you're closer to one than further away, it's good to know that so you can plan and prepare. There are lots of other coverages that you can get, and we're not going to get into all those various little ones that you could do. I don't see them too much around here. One, though, sewer backup protection is something I generally advise people, and this can become part of your hazard insurance or a separate policy altogether. But in these older homes, as we've mentioned, some of the infrastructure is not up to date or hasn't been improved. So you could end up with a serious problem with sewer backup. And that could be costly, not just in removing the water, but the waste that accumulates and things like that. It can get very messy. I do advise sewer backup insurance as a possible thing to consider. So, to wrap it all up, a smart buyer starts his inquiries and his investigation and his shopping on insurance pretty early in the game. If there's going to be a problem, you want to know about it sooner rather than later. You don't want to find out days before settlement that you are going to double your insurance costs or even potentially not be able to get it, because that could be a real problem. So you want to start it earlier. You want to get what you need, not necessarily what's recommended. They could go at either ends of the spectrum. Some brokerages will advise that you need this, and that's higher than the recommended, or it could be the opposite. At any rate, you want to make sure you have sufficient coverage for whichever one you're talking about, particularly in the area of homeowner and hazard insurance. You want to know that you have enough to handle damage to the house if it completely needs to be rebuilt, and adequate liability so that you're not out in the cold should somebody ever get hurt on your property. And you want to get several quotes. There are a lot of good insurance carriers around here, and there are a lot that aren't so good. There are better agents and there are more unscrupulous agents. So get several quotes, get it checked out, compare them side by side, ask a lot of questions, because one of the big things that happens after settlement is something goes wrong and you're not covered, and you want to prevent that at all costs. That's my thoughts on insurance. Get the best deal you can, and good luck at your next settlement.